freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how are you today?
I'm doing great. Happy to...
Looks like you're still in Austin, Texas.
I am still in Austin, Texas. It's a few-day conference.
So remind us what conference this is?
I am at a self-directed IRA conference that you know more about than me, because you're like, I think we should go to this conference. And you're like, but I have no time. I can't go. I'm like, oh, I could go. Then I booked a ticket.
I did kind of suggest that you go. So, but no, I'm excited that you're there. I think it's going to be good. This is something that I think you and I probably need to spend more time diving into. But I think we've done an episode on investing in a self-directed IRA, and if we have not, then that's obviously something we need to do. I'll go back and check after this, but
I think we could maybe get Matt or someone on the show and talk to him.
I think it'd be really beneficial.
That's what we've said in the past.
Yes, exactly. Now that you say that, I remember that. But no, for the quick and dirty there, if you weren't aware that you could invest in private placements through an IRA or with IRA money, you can absolutely do that. And if you've ever called up Fidelity and were like, hey, I'd like to invest in real estate with my IRA, and they're like, you can't do that. Well, what they mean is you can't do that with them. But you absolutely can. You can invest in private placement. You can invest in basically any sort of deal that we do. Now, whether or not it makes sense to do within an IRA is another question, but the fact is you can. You really just need to move it to a custodian that allows you to fully direct what those what you actually invest in. So if you've ever rolled over a 401k or done something like that, it's the exact same process. It just takes a little bit of setup to get the account set up, move some money in there, but you can 100% invest in this space with retirement money if you got an old 401k or an IRA that's invested in money markets and not earning a whole lot. This is a way to get exposure to these deals and potentially put money to work that, quite honestly, a lot of folks forget about. So,
yeah, super valuable.
Absolutely. But that's not what we want to talk about today.
Yeah. So I think, the topic today is it's something that I never thought about in my early days of investing. I'm still early in my days of investing, but my first few years, it was all, I don't even want to say it was cash on cash return, right? It was $1,000 a month. It was always $1,000 a month, and it still is to a certain extent. I think every time I look at a deal, I'm like, how am I going to make another $1,000 a month, right? Because that's a needle mover. In today's society, adding $100 of cash flow, I mean, it can make sense. The investment can totally make sense and only add $100 of cash flow, but you're buying dinner, really. Right? Even a taco truck is $30 now if you're buying 3 burritos. So really, my thing's always been that let's add $1,000 or so of cash flow. But the thing that we're trying to talk about here is return on equity. And I think that it's lost a lot. And we have some partners on the credit fund, and Wes and Tim, and they've kind of brought this idea to my attention, which is return on equity. So it's not how much money you have left in the building. And Tim said this wonderfully at lunch the other day. He said, we would get offers on buildings, and if the return on equity was 4% based off of that offer, then we would hijack.
This is our surprise guest for the podcast today.
Yeah. Dustin's golden retriever, Jack, is joined us in the studio. But if your return on equity off that offer is only 4% and the market cap rate is 6%, and you can go buy another 6 cap deal, it makes sense. And so really, let me break that down a little more. But if you've got, let's try to keep the number simple here, $1 million building, and you're making, let's just say you put $200,000 down to buy it, and you're making $10,000 a year. Let's say $10,000, $12,000 a year. That's 6%, right? $12,000 a year cash flow, 6%.
Now, to go over that math, no investor left behind here. When we're talking about return on equity, that is the money left in the deal.
Yep.
Is what we're talking about. So it's not the total value of the property. So in the example you just gave, it's you calculate your return. This could also be referred to a lot of times as like cash on cash return. It's not always the same, but in this context it is, right? So if you've bought a $1 million building, put 200 grand in it, so that's 200 grand of your own money that is at work here, and it's producing 12 grand a year. That means that 200 grand is earning 6%.
Yep.
And so that's a return on equity because your equity in the deal is 200.
But now let's just say that someone comes in, and so once again, it's a $1 million building, and let's just say someone offers you $1.2 million. Well, now all of a sudden, that offer has created $400,000 of equity, right? So you have your initial $200,000 you put down, and the other $200,000 this buyer is willing to pay for it. And maybe that's the market value, or maybe he's overpaying. And in the case that Tim talked about a lot, it was normally that there was some scenario they were overpaying, right? Maybe not overpaying, but they had a reason to pay a little more. They saw an opportunity. They were in a 1031. They needed to buy it. Whatever the reason was, right? They paid $200,000 more than what their basis was in this hypothetical example. And so now, instead of making a 3% return, or a 6% return that they were making, they're making 3% because their theoretical equity at this sale had just doubled. And so if he knew that he could sell this basically based off of a 3% return on equity, and he could go buy something else that makes 6% because that's what the market is right now. The question can be asked, why is the buyer not doing the same thing? But let's just say this guy's willing to go to a different market, or for whatever reason, he knows he can go buy a deal that is making 6%, then he would make that sale and go roll that money into something else. And this is an oversimplified example, but now your $400,000 is going to be spitting off $24,000 a year at 6%. So you've doubled your cash flow just because you've analyzed deals in a slightly different way. So, and this is not the only thing to look at. I mean, there's tax benefits, there's your basis, do you have a mortgage over basis problem? Do you have, what's your current debt on it? What's your amortization, right? What's your mortgage payment? There's so many things. But I really like this idea because I don't think a whole lot of people think about it. And I think too often you have equity sitting there where maybe you're happy with the depreciation, maybe you like the asset, maybe your debt's good. And all of those lead you to letting you have a 2 or 3% cash on cash return, or return on equity, I should say, when you could go sell the asset and have much higher returns somewhere else with all those same benefits, right? All those other benefits, unless you're in some really weird specific debt scenario. We see some of them now where you've got a locked in rate at 2.7% and it's non-assumable, so you can't transfer it to the seller. You've got some unique situations, but you still have to do the math and just see what it turns out to be. So I don't know, Dustin, what else do you want to?
No, I think you kind of touched on the difference here between cash on cash and return on equity, and in the previous example, how you talked about the your equity doubled. So assuming that the cash flow in a dollar amount stayed the same, that means that the return, the actual percentage return, has now been cut in half. But now at this point, prior to a sale, you've now differentiated between a cash on cash return, which is the actual amount of your money that's in there, which would stay constant, right? That's a fixed number. That's
200 grand you put into the deal.
But now you have some sort of external indicator of an forced appreciation, right? An increase in actual equity. So now, even though it hasn't become liquid because you haven't sold, you now know that 200,000 has actually turned into 400,000. And that's probably now how you should be evaluating, okay, is this actually working as hard as it should? Because yes, it was only 200 of my original money that's in there, but realistically that 200 now, as validated by independent offers from the external market, that 200 has now become 400. And so do I leave this in here? Or is there something else where if the rest of the market is at a 6% cap rate, can I pull that out and redeploy that and now significantly increase my cash flow because I've got double the equity now working at that higher interest rate. And so that's really that I think is the key differentiator here, where the cash on cash is kind of fixed and is always going to be this, or the your cash in the deal is going to be fixed, how much you originally put in. But that equity can fluctuate based on changes in the market. And that I think, Adam, that's the point you're making here, is a lot of people don't even look at that, or they won't think about that, right? They won't look at, okay, well, what, because this is effectively opportunity costs, right? And I wrote about this in a slightly different angle in the newsletter a couple weeks ago, but that's always something you have to be aware of, is what trade-off am I making? Like, literally, by just sitting there and not doing anything, you might be happy with the cash flow, but you also have to be aware of, am I trading something else off here, where there's a lot of equity I've got in this building that I could potentially redeploy in a different manner, and that now is going to produce a lot of additional cash flow because my return on equity has shrunk as the cash flow stay consistent, but the equity has grown. So a little bit of like finance math here, but it's one of those things that, to your point, I don't hear a whole lot of folks talking about. Like, this is a more sophisticated analysis, because what's going to push you to do this, right? If you're, to your earlier point, if you're happy with the cash flow, you're happy with some depreciation, you're getting some things like that, like, okay, well, why do anything? But you've, in this example, how many extra $1,000 a month did you get from like no extra work, right? Like, there was nothing. I mean, yeah, you got to go through the process of selling and acquiring a new building, but at the end of the day, is it really going to be, is the operational to like generate that much, is the operational burden to generate that much cash flow going to be
To
much greater?
double your cash flow, right?
Yeah.
And I think the thing that's maybe a little important here is you can always be an opportunistic seller, right? Like I said, that person buying it may be paying over market value, and it might not be over market value to them, right? They
Yeah.
could be, an example I've seen before is, you're selling a 50-unit building and they own the 50-unit building next door, right? So their management overhead is going to be way cheaper than yours because it's right next door. And so they already have all the teams in place.
Or the buyer's cost of capital is significantly less. I mean,
Yeah.
we've experienced that, right? Where we've gotten beat out on deals by family offices that we look at it and we're like, wow, they really overpaid, but they've got
They're
a lower
happy with
cost.
a 4% return.
Yeah, but it's lower cost of capital for them, and they plan to hold it for 30 years, and that fits their model. So, yeah, that point about being an opportunistic seller is a good one, right? You may not be looking to sell a building, but if the opportunity comes along with someone, whether or not they're overpaying based on your thoughts on it, it's kind of irrelevant, right? If they're willing to sit there and write the check, then you have to decide, do I go ahead and sell this thing?
Yeah, I think if you get the offer, you get in the same example, the $1 million building, you're happy with it, but you'd be happy taking 1.2. Well, maybe you just counter. Well, no, I'm not selling it for 1.2. Okay, and they say yes. Well, now you're happy with the offer that they made.
Yeah.
Anything else you want to touch on this? I know this is kind of a shorter episode, but I think it's just kind of one of those. It's another way to analyze a deal that I think a lot of people don't look at. And there's 10,000 ways to look at anything, but it's another thing to have in your mind.
No, I mean, this is good. This is maybe a more advanced topic, right? This is for now, especially if you've built up a portfolio of cash flowing assets like this, and you have to start looking at it differently, right? And looking at what equity exists in the portfolio. Is it being used the most efficiently? Are you happy with it? And to your point, it's not always about the returns, right? Like, you could look at it and be like, this thing is such, I own this asset, own this apartment building, got a property manager, I love it. I do no work. It throws off this money. I never get phone calls. Maybe that's not worth the hassle of selling and potentially rolling into something that could be more trouble. So life's a series of trade-offs, but you at least need to be sitting down periodically, whether it's real estate or any other type of investment, and be looking and making those decisions and saying, okay, am I actually making the best use? Is my money working as hard for me as I want it to be, and really to the best that it can be right now?
And I don't have a example of this pulled up. Maybe we can find a sanitized version at some point. But my personal financial statement has two columns in it that have percentage of net worth and then return on equity. And so with those two things, I can get an average return on equity, and that will let me see how my equity is performing, right? And if I go and look at something, like some of the oil deals have really high returns on equity. but they deplete, right?
Yeah.
So you can you look and you're like, well, this is a 35% return on equity. Oh, well, why? Oh, okay, well, it's a depleting asset, right? And then you look at something else and it's 0% return on equity. Well, that's no good. Why is that? Oh, well, that's cash sitting in my checking account, right? Like you've got to kind of balance all those things out. But if you do that and you have it all down on paper, right? Maybe it's not down to the penny, but it starts to give you an idea, right? You can build an idea of what your finances look like. It doesn't have to be complicated, just a one-page thing of, value, cash flow, return on equity, right?
Yeah.
And it starts to help you paint the picture yourself of how you want to manage your portfolio. And does it make sense? Oh, this one house, I've got 3 single family homes in Chico, and in the back of my mind, they do well, right? Because they kick off $1,000 a month each. I'm happy, right? I get my $1,000. But then, I go look at, wow, these things have really appreciated. You might not think about it, right? You just continue to be happy with your $1,000. That's where you get a lot of that lazy landlord syndrome.
Yeah.
And from that, you go put it on a piece of paper. You're like, wow, one of them's actually making $2,000 a month, and the others have stayed steady, but they're all worth the same. I should probably sell those twos and trade into something else.
Yep.
So,
no, I think that's great, and that actually now that we say this, we'll offer that up if anyone is interested and wants a sanitized copy or a template of this PFS, the personal financial statement. Because Adam, I really like yours. I actually I have a version of my own, but I like yours better than what I've developed. I need to transfer over that. So if anyone's listening and is interested in this, wants a good way to manage this, because I think it's really good for giving that one page, very quick view of things, send us an email, pfs at wealthindependencepod.com. So PFS, Papa Foxtrot Sierra at wealthindependencepod.com. And we'll send you a template of that, and you can make use of it and start tracking some of your own investments. And it helps you don't have to, it's not something you look at every day, but maybe once a quarter, a couple times a year, go in, update, and make these decisions. And then sometimes when you see some of these numbers in front of you, you're like, oh, wow, I didn't realize that. And it can be really beneficial.
I track another thing I do on top of that is I track the cash flow monthly, right? So that's not telling me anything about my equity, my interest rates, none of it, but it shows me how much cash I get every month. And so, in that you can build, they kind of look like roller coasters, but you can build graphs of how how the cash flow averages month over month. And it lets you see, especially I have part of my formula shows me my trailing 12. And so you can kind of see, oh, well, this has done really well over the last 12 months, or this house hasn't, or, especially when I have some houses that are all in the same neighborhood doing the same thing. And you're like, well, why is that one making more and that one's not? It gives you the starting point to dive in and analyze your portfolio.
Well, I like this topic. This was good. Anything else you got, Adam?
That's all I've got.
All right, well, we can get on out of here. We appreciate it, everybody. As always, if you got questions, reach out. We got a contact form on the website, wealthindependencepod.com. We'd love to hear from you. But we will catch you next time. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.